Good morning and welcome to this Moneycontrol live stream. You're watching Opening Bell with me, Nandita Khemka. You know, the last session before the big day, that's Sunday. That's when the Finance Minister will be announcing or unveiling budget announcements at 11 a.m. But yes, that will be a trading day, a full trading day, so to say. But today happens to be the last one before that crucial event that the market is watching out for. Lots of discussions lined up. Lots of stocks will be in focus. We'll discuss all that, and of course, all your stock-related queries. Keep them coming in between 8:40 and 9 o'clock. We'll try and get them addressed by our experts joining in on the show. Before moving any further, quickly take a look at the top stories at this hour. Mixed cues from global markets. The S&P 500 ended lower for a second day on the trot, weighed down by disappointing earnings from Microsoft. Asian markets are largely mixed. The Nikkei is edging lower. The Kospi was trading with gains of somewhere around 1% or so. But the GIFT Nifty is hinting at a triple-digit cut on the Nifty today. Mind you, the Nifty has been gaining for the last 3 sessions. Today, let's see whether we manage to extend gains or will we snap out of that gaining streak. Crude oil prices have climbed nearly 3% to a 5-month high, with Brent crossing the $70 a barrel mark. The gains came amid rising concerns that global oil supplies could be disrupted if the US carries out military action against Iran. Meanwhile, gold prices have eased to around $5,400 an ounce as investors book profits after recent record highs. Silver, meanwhile, has also cooled off from peak levels. US President Donald Trump is set to announce the new Fed chief later tonight. According to reports, the final 4 candidates include former Fed Governor Kevin Warsh, National Economic Council Director Kevin Hassett, current Fed Governor Christopher Waller, and BlackRock's Chief Investment Officer for Fixed Income, Rick Rieder. And India's Chief Economic Advisor V. Anant Nageshwaran says that the Indian rupee is not an outlier among global currencies. He adds that the weakness in net foreign inflows into Indian equity markets is not linked to tax policy alone, pointing to instead to broader global factors. In key earnings, ITC has reported third quarter results that are broadly in line with expectations, with revenue rising nearly 6% year-on-year. Paytm, meanwhile, reports a net profit and Dabur too sees margin expansion. Watch out for earnings from Bajaj Auto and Nestle later today. Alright, let's just take a quick look at the cues for trade then. If you look at the global texture, extremely volatile. We saw wild moves when it comes to the US markets last night. The Dow ended in the green. S&P 500 has snapped out of a 2-day gaining streak. In fact, it kind of logged losses for a second straight session. But the moves are fairly volatile. Although we did saw Wall Street ending off the day's low. Asian markets are fairly mixed. Kospi was gaining somewhere around 1%. Microsoft earnings disappointed on Wall Street, and which is why we saw S&P 500 ending in the red. But there were a couple of earnings that managed to beat expectations, and we saw it play out on the stock prices as well. Apple beat estimates by due to a significant surge in iPhone sales. Meanwhile, the most important cue for today, when it comes to the Fed, would be the fact that Trump has said that he will be announcing the Fed chairperson later tonight. Of course, the top contenders are the likes of Kevin Warsh, Kevin Hassett, Christopher Waller, and Rick Rieder as well. Look at the GIFT Nifty. It has been weak, and of course, it has been sliding as well. Last time I checked, it was down somewhere around 140 points or thereabouts. Yesterday, we saw a very good recovery coming through for the benchmark indices. 25,400 was reclaimed. We recovered almost over 240 points from the day's low. But the broader end of the markets were muted. Mid caps were underperforming. The market breadth was also in favor of declines, despite the fact that most of the major indices ended the day in the red. But the Nifty Bank Index, that deserves mention. It managed to outperform the likes of Axis Bank, AU Small Finance, ICICI Bank even, and Federal Bank. All of these counters contributed to the up move on the Nifty Bank Index. Metals, they were shining bright once again for the third straight session. We saw very strong gains coming in on metal stocks. But today, watch out for metals. Perhaps we could see some bit of profit taking, given the fact that the underlying metals, the precious metals, did see a fair bit of correction on the back of profit taking. In terms of fund flows, we saw a meager buy figure yesterday, but now today we are seeing a meager sell figure, 390 crores worth of stocks sold in the cash market by the FIIs. But the selling seems to have abated a bit. The pace has slowed down a bit, but let's see, how things really pan out here on. And of course, FIIs will also be watching out for the budget announcements on Sunday. So, we'll see how things pan out on that front. DIIs were net biased to the tune of 2,600 crore rupees or thereabouts. But on that note, let me bring on board our guests for today. Joining me, Raja Venkatraman, co-founder, NeoTrader. And also joining me is Dharmesh Kant, Head of Research, Cholamandalam Securities. Gentlemen, great to have you this morning. Raja, coming to you first. Looking at the setup, what would be the call for today? It's the last session before the budget announcement. And yesterday we saw a good recovery, but the GIFT Nifty is not hinting at a pretty picture this morning. So your call, which way do you think the Nifty will head and what are the levels you'll be watching out for?
Yeah, good morning, Nandita. Thank you for inviting me to the show. So, well, as we are looking at the markets, like you said, we are on a recovery stage. So, when we are in a recovery stage, we should definitely address that it's not going to be a linear path upwards. And we can see that, yes, at the lower levels, we seem to have found some feet at 24,900 to 25,000. But then the upward trajectory solely depends now not only on the domestic cues, it also depends on the global cues as well. So now we have the budget coming up, which could be a very important trigger. We had the Q3 season, and that did not actually hold this decline which we saw, nearly a 1400 point fall. Now, what we need to see is that can budget provide the trigger which we are expecting for, and also the RBI policy which is coming up. So all these things will matter in the coming week. So next week again is going to be an important week. So what we are seeing right now is that the volatility continues. 2025 was a very volatile year. 2026 also continues to be the same. And I think that this kind of scenario is going to persist. So when such kind of scenario is going to persist, then it's better that you keep booking profits. And like you mentioned at the start of the show, some profit booking definitely looks to be in order. But that does not disturb the sentiment here, because the sentiment is on a recovery path. And ahead of the budget, I don't think that too much short buildup will be there. It's a long weekend as well. It's a weekend, and the reactions will be flowing in only.
Long working weekend, you mean? Raja.
Yeah, long working weekend. Yeah, I stand corrected. Long working weekend. So Sunday, of course, there will be some action, but then it will not be to the tune of what you will see on Monday. So Sunday and Monday will be an important decider for the trends ahead. Of course, the budget reactions will flow. Then we have the RBI policy. So a lot of action in place. So my take will be that around the 25,000 levels are going to hold. On the upside, I would say that on the Nifty spot, 25,500 to 600 is an important resistance zone. If that is crossed, then 26,000 is on the order. Otherwise, it's going to be a range-bound week for the next week.
All right, expect a range-bound week, but sentiment has improved according to Raja. Dharmesh, coming to you as well, sentiment was very downbeat, right? But last few sessions, we've seen, the Nifty stage a good recovery. But, historically, if you look at the budget day moves, it has been fairly, flat to inconsistent. I was just reading, this report where it says that Nifty delivered 0.2% average returns during budget day in the last 15 years. What's your sense? Although even if we are flattish around the budget day because expectations are low going into the budget, would you say that the bulk of the correction is out of the way and sentiment has taken a turn for the best now?
Yeah, good morning, Nandita. Thanks for having me for the show. Yeah, definitely it looks like bulk of the pain has been taken away by pre-budget type of a correction which we have seen. And this correction is coming in the light of a earnings season which has not been bad at all. See, if you remove the Nifty stocks, which includes IT and few of the large caps, we have done an aggregate of around 230 companies as of yesterday. And the results were startling. 28% kind of a year-on-year growth on the PAT has come, and 8% quarter-on-quarter growth for those 230 companies, which is largely into mid and small cap space, despite having labor code impact taking into account, with operating margins improving. Entire financials we have seen, asset quality being improving, credit costs getting lower down, and credit growth is slightly picking up even in the private sector space. Public sector space has been doing well. in light of what government has done last 1 year, be it direct tax cut, indirect tax cut, and RBI's help with the interest rate cut, inflation being benign, I think now the cherry picking will happen. Budget, to my mind, as you have rightly pointed out, is a 0.25% kind of a move. It's more of a psychological impact rather than actual impact on the market. So it will come and pass through. We should not pay more attention to it. If you want to build up a position based on the good earnings flow, I think this is the right time to start doing cherry picking and investing. So my own sense is, since we have seen a correction pre-budget, and budget is likely to be a non-event, it's likely to be an enabler kind of a budget with a more of Make in India PLA scheme, import substitution kind of a budget, which is on in a way it's a deferred expenditure by the government. So first you spend and the government will come and help you. So it will be a
Sure.
strategic kind of a thing. I think buying should be the order of the day from here on.
Okay, that's the view. We'll talk about specific stocks as well now. I just want to take our viewers through what the stocks or the headline stocks in news are this morning. Hold that thought, gentlemen. We'll come back and talk about stocks. ITC is a big one because it reported numbers post market hours yesterday. Profit was down somewhere around 6% at 5,088 crores, but that was largely in line with expectations. Revenues grew somewhere around 6%. And margin wise as well, it was somewhere around 34.8% vis-a-vis 34.2% on a year-on-year basis. If you look at Dabur, profit growth was somewhere around 7%. Revenues grew somewhere around 6%, and margins came in higher at 20.6% vis-a-vis 20.3%. For Colgate, profit was largely flat. Revenue growth came in 2%, and margins came in lower at 30% vis-a-vis 31.1%. Tata Motors, commercial vehicles, that also reported numbers. Net profit was down somewhere around 48%. Revenues, although, were up 16%, and margins also came in higher at 13.2%. Vedanta, good set of numbers. Metals, of course, have been in focus any which ways on the back of the rally in commodity, the precious metal prices and base metal prices as well. But Vedanta saw a 60% growth in net profit. Revenues grew 37%. Margins were although flat at 29.4%. That's one stock that will be in focus, but we'll have to see whether, we see some bit of profit taking when it comes to metal names today. Paytm, good set of numbers. Profit came in higher at 225 crores versus a loss of 208 crore rupees on a year-on-year basis. So yes, it swung to profit on a year-on-year basis. Revenues were up 20%, and EBITDA also was in positive at 150 crore rupees vis-a-vis a loss of 220 crore rupees or thereabouts. And another one that I want to talk about is Swiggy. The net loss widened at 1,065 crore rupees vis-a-vis a loss of 800 crore rupees, but revenues were up 54%, and the EBITDA loss also kind of came in higher versus the same quarter last year. So a plethora of earnings. I can't really go through everything right now, but in terms of ITC, I want to throw in a question to you, Dharmesh. We had that cigarette excise duty setback. Although numbers are fairly good, but what is your view on how ITC is expected to pan out from here, and is there a case to buy this stock at the current juncture? How would you look at this stock, particularly after that excise duty disappointment that came in on the first day of this year?
Yeah, Linda, after 3 years, this excise duty thing has again cropped up in ITC. Otherwise, since the excise duty was silent, the ITC company stock price was doing well. If you do the SOTP part of ITC, so 85% of the contribution in the PAT comes from the cigarette division. If you look at 10 years kind of a performance of ITC having regard to this contribution from the cigarette division, it's a single digit kind of a CAGR, be it on profitability, on revenue. So, and the ROEs are around 25-24% compared to say that of HUL, which is 50%. So my own sense is ITC, the correction has happened. Maybe it can be fairly valued, but this valuation is going to stay for a long time. There is no growth trigger coming into the profitability front. If the profit doesn't grow by say 12-14%, why would somebody pay 25 times earnings multiple to any business? So that is my sense. Trading bounces may happen here and there, but I don't think ITC is going to find flavor with wealth creation kind of a flavor. Trading opportunities can come and go. So We have been, quite bearish on the entire FMCG space, not only ITC. And after the GST cuts also, we have been bearish, and the stock prices are also not, helped that count.
Okay, that's a bearish call coming in. But of course, Dharmesh, you said that trading opportunities may come and go. Is there a trading opportunity, Raja? Let me throw that question to you.
Yeah, I would say that ITC is best well left. If you are trading intraday, it's fine. Otherwise, these kind of moves are not what I would look for. ITC has been on an exit mode for quite a while, and over the last few sessions, it's actually been declining. So there's not much to gain from trading ITC. There are better bets available in the market out there. So it's best well left. So it's a exit call as far as the investors are concerned. And as far as trading is concerned, there are better bets, I would say.
Trading, as far as trading is concerned, there are better bets. But are there any better bets within the FMCG space that you are tracking, Raja, since you said that ITC is better left alone?
Yeah, in FMCG, I would definitely like to throw some light on Marico, because I find that Marico has been, the results also were decent, and I would say that if one wants to look at, trading opportunities or investing opportunities, Marico would be a better bet, because I feel that from the levels of around the current levels of around 730, it augurs well, and it can move towards level of around 800 to 825 within the next 3 months.
Okay, Marico, of course, numbers were also fairly good, and that's one pick from the FMCG space. But let's talk about Paytm. Dharmesh reported a net profit, in excess of 200 crores. The stock has seen a good up move, but in recent times, we saw sentiment taking a fair bit of a hit. On the back of RBI's PIDF scheme, there was uncertainty about whether it will be extended or not, and we saw sentiment take a hit on Paytm. But looking at the numbers, do you think there is a decent enough case to look at Paytm despite that? Because the company has also said that it will look at making up, the impact arising out of that.
These numbers are historical numbers. This is for Q3 numbers where the impact was not there. The impact of the scheme being taken away will come into the Q4 earnings season, and there is around 2 to 3% kind of profit impact should be there. That's our estimate. But the management has said that management has also acknowledged the same. They have said that this will definitely have an impact, but they will try and come out with new revenue generation avenues through which they will make up for that. So it's a wait and watch kind of thing as far as the numbers are concerned. But again, a very expensive stock. The good part is it has turned profitable. It has demonstrated that. Then certain problems cropped up, and again the correction was there. So give it to 1 or 2 quarters from investment perspective. So that is my call. I mean, but from trade perspective, I think there will be some flare up here.
Okay, all right. For an investment perspective, we'll have to wait for a couple of more quarters to see how things really pan out. Raja, your thoughts? Technically, how would you look at Paytm?
Yeah, as far as the NBFCs are concerned, they have been showing some promise. But Paytm, after some sideways movement over since the last numbers, you would see that it has been unable to actually stage a rebound here. So what I feel right now is the recent breakdown which happened below the around 1250 levels. It clearly says that there has been some exits as far as the investments are concerned, and also on the trading side, there has been some shorts that have been introduced. So I feel that the selling pressure could continue. So if those who are intending to trade on the downside, Paytm could be a good bet, I would say.
Okay, that's about Paytm. But just want to get in your thoughts on a Jubilant Foodworks as well. I was just going through some brokerage notes. CLSA has upgraded Jubilant to hold from underperform, and they have raised the target price. I think at 477 or thereabouts. Even for Westlife, it has been upgraded to hold from underperform. The target here has been set at 500 rupees per share. But they are still cautious on Jubilant Foods' near-term sales amid higher competition. There's a very interesting sector, right? The space, the whole restaurant chain space. There has been a fair bit of consolidation as well. Devyani International, etc. Is this case looking like, is this pocket rather looking like an investable bet? Dharmesh, coming to you first, are the prospects improving for these names, some of these names like Jubilant, Westlife, etc.?
Nandita looks difficult because what each of these companies did 3 years back was they went on capacity expansion. They invested quite heavily into the new stores, but unfortunately, the new store sales growth did not come through. The unit economics did not work out for them, and that was the reason why interest and depreciation started hurting because the operating profits were low. Even same store sales growth in say Devyani or Sapphire has not been picking up well. So restaurant business itself is seeing a bit of a down traction rather than up traction, and that is what is hurting them. But Jubilant is more of an offline model kind of a service restaurant, which is fairly, I mean, slightly relatively doing better than the rest of the pack. So valuations are a bit expensive. Short-term triggers may still be there, but I think IPL season and all are coming in where these companies find traction. So if you want to stay in this space, then Jubilant is the best pick out there. Others, to my mind, should be completely avoided. They are not out of the woods yet.
Okay, not out of the woods yet. That's about QSR. But what about Quick Commerce? Dharmesh, Eternal reported numbers, but beyond the numbers, there's been a change in the CEO as well. And Swiggy's number, if you look at that, the net loss has widened and EBITDA loss has also widened. How would you look at the likes of Eternal and Swiggy post the recent developments?
Yeah, Eternal, when it started, it was a food delivery kind of company, and then they took over Blinkit, and Blinkit now has 75% plus share in the top line. So it's likely Albinder Rinsa taking over as the new CEO because he is the one who is controlling the lion's share of the Eternal's business. But the cash flow continues in the quick commerce space, and same has been seen in Swiggy's result yesterday. Though if you look at Q and Q, 11-12% kind of a growth was there in the top line on a blended basis all put together. But there was a cash burn decline only by -2% from 799 crores to around 765 crores. The kind of a cash burn was there. So this is likely to continue. Let's not forget, Reliance is coming in a big way in the Q-commerce space. There's Amazon, which is now deepening its teeth. At the same time, Flipkart, backed by Walmart, is again there. So three big competitors are falling into the space. Valuation wise, I did all type of permutation combination, even gave it a margin of 6-7%. It's still very high, 20 times EV to EBITDA multiple 10-year forward. So that doesn't make a case. My own sense is it's better to stay away from the space
Sure.
rather than even trying trading attempts.
Okay, stay away from the space. Of course, competition blues are only intensifying for quick commerce. But let's shift focus to some queries then. I think I have a query from Naveen on a Canara Bank. Let's address that. Viewers, if you have any queries, you have a 5 to 6 minute window. Keep them coming in. I'll throw them to our guests and we'll get your questions sorted. But this one's on Canara Bank coming in from Naveen. Wants to know if it's a good time to look at Canara Bank from a positional perspective. The stock has, of course, been a very strong performer, but in recent times it has been witnessing some profit taking. Is this a good buy on dip opportunity, at least for those who are looking at taking a positional bet on this stock?
Is addressed to me, right?
Raja?
Yeah.
Yes, Raja,
Canara,
that's to
Canara
you.
Bank. Yeah. Canara Bank definitely is amongst the PSU banks, one of the top favorite movers. But then off late, it has spent some time in consolidation. And what we see is that the PSU banks have been performing. They have been able to hold Bank Nifty well. And certain performers like SBI, Indian Bank, they have outpaced Canara Bank. So in terms of that, even the Bank of India, Union Bank, so all the PSU banks have run up. So now in that case, if you want to consider some late entries, then Canara Bank definitely makes a cut because from a positional play, I think that a target towards 225 is possible within the next 6 months. So one should definitely look at Canara Bank because it is going through a consolidation, and a revival today should be seen as an opportunity to enter.
Okay, that's the view. I hope that answers your query. Naveen, we just discussed a quick commerce with Dharmesh, but since we have a query, want to come to you on that, Raja. Also want to get in your thoughts. Satvika wants to know if Swiggy is a good stock to hold for the next 2 years. A little, longer term perspective here on Swiggy. For Satvika, what would you tell her?
Yeah, the entire quick commerce space has been going through a lot of gyrations, and Swiggy, since its listing has never really materialized, at least Eternal showed some promise. It also generated some flows out there. What right now we are seeing is some exits from Swiggy, and I feel that it is better to look at Eternal on a revival mode than Swiggy if you're looking at a 2 year horizon, because 2 years definitely long term, and I feel that yes, this area will definitely develop, because that is something which all of us are getting used to. But I would say that in the quick commerce space, Eternal will be definitely a preferred bet at the current levels.
Okay, Satvika, Eternal would be a better bet compared to Swiggy. Hope that answers your query. Couple of more queries then, very quickly I'll get them addressed. Coming to you, Dharmesh, Satya CK has written in, he's our regular viewer, and he wants to know your thoughts on GMDC for fresh entry for a medium term. Given the kind of rally this stock has seen, valuation wise, do you think it's not a very good idea to look at GMDC now?
So that's the case with any, metal and mining stock. So far as valuations are concerned, everything, all have seen a big rally, and rare earth mining did the trick for GMDC. I mean, approval may come through. So, but if you are a momentum trader, then I think Raja is the best person to address it. Keep a stop loss and keep it trailing and enjoy the ride. But one has to be a brave heart from now on to enter into any of the metal stocks having regard to the valuation multiple. So my only advice is, even from the fundamental perspective, you should have a SL in place for taking any metal trades from here on.
All right, that's about it. Hope that answers your query, Satya. But I don't have much time. I can only squeeze in two more queries. Raja, coming to you, Komal Makecha wants to know. I think we've already covered banks, and you mentioned Indian Bank as well. So, Komal, perhaps you could go back in the feed and view Raja's answer on Canara Bank. You'll get your answer there. Another query that Komal has sent is BEL, Bharat Electronics, for fresh entry for the long term. Defense stocks had gained traction earlier this week. We saw big moves on shares of BEL as well. Numbers also were pretty strong. Do you think it looks okay for a fresh entry now? Raja, let me pose that to you.
Yeah, the defense counters have definitely shown a lot of promise, and amongst them, the best promise and continue to retain that promise is BEL. So I would definitely wager my bet on BEL at the current levels. Look at dips towards 400 also as an opportunity to buy into, considering the extent of move which we have seen over the last few months. I would say that you should look to parcel your approach, buy at current levels, buy on dips towards 400, because it is holding a lot of promise. And amongst the defense names ahead of the budget, BL is definitely looking an exciting prospect.
Okay, that's your answer. BL looking like an exciting bet for now. But Raja, I would have to let you go. But before I do that, what would your trades for the day be?
Yeah, despite the all apprehensions regarding the metal names, I still continue to share a metal name, which is JSW Steel, because amongst the metal names, the prominent metal names have not actually come to the fore. Now, with inline reports of its Q3 numbers and also a base out of its consolidation, I feel that JSW Steel holds a lot of prospects, and I feel that that could be a stock to consider for a multi-day play. So one could look at buy at current levels and have a stop loss around 1210 for a target towards 1350 within the next 2 to 3 weeks.
All right, those are some of the recommendations. Raja, with that, would like to thank you for taking out time and joining us. Look forward to our next conversation as well. That would be post-budget.
Sure. Thank you.
Thanks a lot. Since Dharmesh is here, Dharmesh, I would like to know the compounding ideas that you have for our viewers. But before that, just want to get in one more query that we have, on our feed. OFSS, Oracle Finance, coming in from Sri Anandaroop. How would you look at some of these mid-cap IT names now? Most of them have reported numbers. What's your overall view on IT, and how are you placed when it comes to mid-cap IT, particularly OFSS?
So OFSS, I mean, a couple of quarters numbers were not that great. One of the quarters was good. So it has been an erratic set of numbers. But I think one should be looking at mid-cap ITs from here on. Most of the companies have shown, I mean, have corrected quite a bit, be it KPIT Technologies or Tata Tech and all. So we are more focused on engineering point of view from mid-cap IT companies. For example, Tata Technologies is more into automobile engineering, designing concept, and the entire Internet of Things for these cars, software-defined vehicles. They have been there, and the time is coming where next 1 year, lot of with EU trade deal happening. Most of these companies will see good traction from overseas companies as well, as far as orders are concerned, because it takes 6 months to 1 year time frame before you develop this software for new vehicles to get onto road. So those are the pockets which I think looks interesting. But you have to be very stock specific. You have to be bottoms up approach if you are approaching IT companies, irrespective of the fact that you are having a tailwind from the currency depreciation.
Okay, that's the view on IT, especially the mid-cap IT space. But, Dharmesh, before I let you go, what would your compounding idea be for viewers?
Yeah, I mean, at this juncture, how the earnings have panned out, I think two sectors are clear compounders. One is the entire banking space, where I think that they are at the best of the health as far as asset quality is concerned, 0.3, 0.4 times, I'm at 0.4 net NPAs, and the growth has been good. I think private sector banks will also pick up from here. So one compounding idea is IndusInd Bank. I think the worst is through. If you are able to hold it for 1 year, it would be with one-time price to book. It will be a great story to hold on to for next 1 year. And the other is from the defense space, obviously. And Hindustan Aeronautics is a company which I think will deliver a very good set of numbers. It's standing at 6 times book to bill ratio. So order book is 6 times its current revenue. And the GE 414 engine supply has started from US. So they will be delivering a lot of Tejas MC-1A and 2K aircraft to the Air Force. So I think 4 or 5 deliveries will be there, which will take up significantly up the revenue and operating margins 22-23. It's trading at 30x 1 year forward multiple, which is safe. We have a target price of, say, from 3 years perspective, 6,000 on HL.
All right, those are the compounding ideas coming in from Dharmesh. With that, Dharmesh, would like to thank you for taking out time and joining in. Always a pleasure, and look forward to more conversations in the future as well. Wish you a very happy working long weekend.
Thank you so much. Wish you the same.
Thank you. Thanks a lot. Just before I shift to the lead story, just want to see what the market is doing in the pre-open session. The Nifty is down somewhere around 170 points. So, doesn't look like we are poised for a positive start. The gains that we saw over the last 3 days, we could see some kind of a speed bump there, given the fact that global Qs aren't positive, and the GIFT Nifty was also hinting at a triple-digit cut on the Nifty. Let's see whether the bulls have it in them to claw back from the day's low, what they did yesterday, if they can replicate that today as well, given the fact that this is the last session before we head into that very crucial budget day. But on that note, it's time for the lead story. All right, on our lead story this morning, of course, as I mentioned, we are heading into the budget session on Sunday. All eyes on that, and of course that would be the lead story, given the fact that we are all waiting for what kind of announcements the FM will make at 11 a.m. on Sunday. But we will focus in on the big numbers to watch out for in the budget. Let me bring on board Aditi Nayar, Chief Economist at ICRA, to take us through her expectations. Now, Aditi, lovely chatting with you this morning. We had the economic survey yesterday. It pegged growth at 6.8 to 7% or so. What is your sense? The mood is that of caution but not pessimism. That's what the economic survey language was, right? Is the government likely to stick with the 7% growth narrative in the budget speech? What is your expectation?
Thank you and good morning. In terms of the economic survey, so a few things that they've done on the growth side. They have now pegged the potential GDP growth at 7% instead of 6.5%. And for FY27, they have basically kept a range around that 7% mark only, 6.8 to 7.2%. Although they have cautioned on external headwinds and the fact that they could continue to cause disruption. But the story is basically coming out, the narrative is really that we have a lot of domestic resilience, especially on the consumption side. And that is going to help us power through to a 7% growth in FY27. Now, on a side note, I'm slightly more cautious than that. On the current 2011-12 GDP base, which is going to be replaced in a month now, my forecast for FY27 is a tad lower at 6.7%. Having said that, I do think that now the budget is going to pencil in a 7% sort of real GDP growth number and look at nominal GDP growth in the range of 10 to 10.5%. Now, as I was saying, the new GDP base will be coming out in a month, and that could lead to the GDP baseline being different in level terms, and therefore the growth numbers for different years could also end up being modified up or down. And when we have a different nominal GDP base, basically that is going to end up affecting the fiscal matrices that we have that the budget will be presenting on Sunday. So things like the debt to GDP number, the fiscal deficit to GDP number, the revenue buoyancy that is assumed by the budget, all of these will get altered once we have the new GDP series coming in about 4 weeks from now. On the current base, I'll give you my forecast. Basically, we are looking at a modest tax revenue growth, compressed by the fact that the cess is now getting very changed now that the GST compensation cess is basically getting replaced by the new cesses which are coming in. So that is going to have an impact on the overall revenue growth number and the revenue buoyancy number. We are penciling in a 1 percentage point reduction in the debt to GDP ratio, so very modest. And we think that a 4.3% of GDP fiscal deficit will be in line with that. So not a whole lot of fiscal consolidation coming in. With all the tax rationalization that has happened in the last 1 year, I think now the focus really needs to shift to the expenditure side. Here again, the Finance Commission and its recommendations will influence the fiscal space both for the Government of India and the state governments, and basically have an impact on what kind of expenditure they prioritize going ahead.
Okay, what is your sense? Will they prioritize capex spends, and your sense on how the government could actually boost private capex, because that has been a pain point.
See, I certainly hope that the government is going to maximize the fiscal space available for government capex this year, particularly from the point of view that we are about a year away from the pay revision, and that will take up a hefty chunk of the fiscal space in FY28. So this is a year where we can prioritize capex, and I'm really hoping to see a double-digit growth in FY27 in Government of India's capex. And within that, I also hope that the allocation for the 50-year interest-free capex loans to the states will get enhanced, because that will also allow some more flexibility in terms of the sectors in which the capex will go through, because the states tend to spend on slightly different sectors from what the center does. So that will give us a more broad basing in terms of the capex push from the government side. And certainly, on private capex, our view has been that it's not that private capex is not happening. It is happening, but it's happening in select sectors. And therefore, it doesn't feel like that overall overarching sort of macro push towards private capex. I do suspect that it may be a little bit more of the same in FY27. Anybody that is involved in exports or where imports are very competitive is going to shy away from committing capex right now. And I think that's just the reality. Domestic focus sectors where imports are not such a threat, that is where private capex can actually stand ahead of the pay revision.
Sure. Aditi, just hold that thought. We'll just take stock of how the markets have opened up for the day. I'll come back to you in just a minute. Let's take a look at the Nifty. We've ended lower, down in triple digits as the GIFT Nifty was hinting. A 145-point cut on the index. We've slipped below the 25,300 mark, 25,280 or thereabouts. That's where we are at. The broader end of the markets have taken a sharper knock. In fact, the Nifty Mid-Cap Index has slipped below that 58,000 mark as well. Almost a 1% cut on the Nifty Mid-Cap Index, and the breadth is not looking very good. 1:4, that's the NSE advance decline ratio. Just 450 advances to 1800 declines. So yes, yesterday as well, the breadth wasn't all that great, even though the Mid-Cap Index was in the green. But today as well, the selling has kind of exacerbated. Taking a look at some of the sectors, then I want to see what the metal index is doing, given the fact that we saw some sharp correction in the prices of gold and silver. I think there is some issue. My screen is not updating, but just yes, the metal index is down 3%. Mind you, on a week to date, the metal index was up 7.5%. Saw very solid gains in the first three days of the session, 3 or 4 days. But of course, today a 3% knock coming in on the metal index. In terms of individual movers, then let's take a look at which are the sector stocks that are on the downside. Some of them, in fact, most of them are from the metal names: Hindalco, Tata Steel. Coal India, JSW Steel, all these counters are down. Some of these IT names, Infosys, HCL Tech, they are also trending down. M&M, ONGC, SBI Life is another one that's extending losses. So yes, the list of losers is quite long. The list of gainers includes the likes of Nestle, that reports numbers, by the way, Grasim, Interglobe Aviation, ITC is also in the green, post numbers. Cipla, Power Grid, these are just about a handful of counters that are gaining in trade. We'll take stock of some of the mid-cap stocks in just a bit. But Aditi, in terms of the big numbers in specific, talk about the fiscal deficit figure that you are anticipating in terms of tax buoyancy. Also, you mentioned about it, but what are your expectations there? Capex figures. Let's talk figures. Take us through your, what you guys are expecting at ICRA.
So basically, in terms of figures, see, on the tax side, we are expecting direct taxes to do better than the indirect taxes in terms of growth, because the GST overhang from the rationalization is going to continue for the next 6 months. And then the cess related changes will be there as well. So we're going to look at a very low buoyancy of tax revenue growth this year. On the non-tax revenue side, we do think that the dividend from the RBI and the PSUs will be quite supportive. We've pegged in a normal sort of a disinvestment year, nothing spectacular on that front that we've pegged right now. On the expenditure side, there are a couple of reasons that we feel that the revenue expenditure growth may not be very high next year. Our understanding when we're reading through, when we're passing through the numbers for FY26, the non-interest, non-subsidy revenue expenditure growth has been very, very low this year. And there's a huge headroom left to spend on this account in the last 4 months of FY26. In fact, we'll get the December numbers this evening and we'll, get a better sense of how things have moved in the month of December. But my sort of guess is that moving more schemes to the just-in-time fund release mechanism, which the Government of India has adopted in the last couple of years, that is something that is leading to a very low growth in the non-interest, non-subsidy revenue expenditure of Government of India. And again,
okay, I think we've lost Aditi's feed there. We'll see if we can get her back. But let's take stock of the market then and see what is really transpiring. In terms of the sectors, it's only the FMCG pocket that's trading marginally in the green, and pharma just about mildly in the green. But metals, they are the big losers today. Gold and silver saw fair bit of profit taking, and post that, in fact, the metal index is down 4%. Of course, on a week-to-date basis, the metal index has gained somewhere around 7-8%. In fact, 3% on a week-to-date basis. But today, obviously, it has erased half of those gains, which is why we're seeing a 4% cut on the metal index. IT, that's down 1.5%. Energy down 1%. Energy stocks or energy sector has also been upbeat. We've seen Brent, above that $70 mark, a macro headache. for the government, but stocks like ONGC, Oil India, have seen a fair bit of run up in tandem with what the crude prices have been doing. But Aditi, since I was talking about crude prices, back above $70 on the Brent, 3-4% up, in a matter of days. A renewed macro headache for the government. Your thoughts?
See, my sense is that the pump prices will probably be kept stable, and it's going to be the dividend that will adjust up or down. That seems to be how things clear basically these days. Earlier, we used to have the subsidy mechanism, which was the market clearing mechanism in terms of the prices. Now I think it's more dividend which gets adjusted up or down, whereas pump prices are kept the same. So perhaps that is something that could bring down the dividend that the government would get to some extent in FY27 as compared to what we would have initially thought.
Okay, that's the view, Aditi. I would like to thank you on that note for taking out time and joining in and sharing your thoughts. Of course, we're all counting down to the budget. Post-budget, I would like to touch base with you and discuss the key announcements as well. Thanks a lot for taking out time and joining in. Always a pleasure chatting with you. Well, that was Aditi Nayar with her expectations on the key numbers to watch out for in the budget, and of course, she also touched upon the surge in crude prices and how it would be offset by the government, really. But just take stock of some of the mid-cap movers, because the breadth of the market is not looking good. And let's see what the Nifty 500 index is indicating in terms of laggards. Some Hindustan Copper, of course, after the stellar moves, the stock is down 6.5%. Nalco is down 6.5%. Hindustan Zinc as well, down 6%. Vedanta, of course, the numbers have been fairly good, extremely good, but the stock, of course, had seen a fair bit of run up already, which is why we are seeing profit taking here as well. Despite good numbers, the stock is down somewhere around 6%. Swiggy, net losses have widened. I think there's a downgrade call as well on Swiggy. That stock is down 5.5%. Capri Global, that's another one. Graphite India down 5%. Hudco is down 5%. NMDC Sale, Rainbow Children's that reported numbers just a few days ago. That stock is also under pressure, and so is Voltas. It reported numbers, by the way. That stock is down 4%. Let's take stock of some of the gainers as well. Those shipbuilding companies continue to gain as they usually do ahead of the budget. Defense and shipbuilding. GE Shipping is up another 3.5%. Dixon reported numbers. Of course, the stock has already seen a fair bit of hammering, but the stock is up 1.5% post its numbers. Nestle ahead of numbers is up 1.5%. Amber Enterprises is also up. Ipca Labs, Aether Energy, Dabur post numbers, it's up somewhere around 1% or thereabouts. And I can see some green on screen for some of these automakers as well. Maruti, I think, is among the gainers today. But both Maruti and M&M have seen a fair bit of, wobbly trade in recent times. Autos as a basket have seen some pressure. That's what things look like at the current juncture. But Nifty now down almost 180 points, 25,250. That's where we are at. But let's see whether we have our next guest ready for us. It's time for the market maker. Well, Yogesh Patil, CIO Equity at LIC Mutual Fund, joining in our market maker segment. Yogesh, lovely to be interacting with you this morning. Welcome to Moneycontrol. Just about a day to go for the budget announcements, but from a market perspective, how would you look at it? Because the moves on budget days are largely flattish to inconsistent, so to say. And expectations fairly low as far as all the chats I've had with various market guests. They've said that expectations are low, so if there is any positive surprise, the markets will latch onto it with both hands. What's your sense? If at all there's a positive surprise, what would it be?
Good morning, everyone. You are absolutely right. If market is very low expectations, even the F&O indicator is indicating net short on market. So definitely position is light and expectations are low. The only thing is mattering here, majority of sellers are FIs. So we need a more clarity on taxation front, and there either maybe or maybe rationalization of taxation, because still India, the current account deficit is actually reduced in last 20 years, but still is funded by FIs. The large portion is actually impacted due to FIs outflows. And at same time, nowadays budgets are not a very important, because we see in last 6 months, I think GST cut plus there's so many reforms, labor reforms, which can be done out of the budgets also, and whenever the government thinks it's necessary. So there is no urgency over if something is not announced in budget doesn't mean it will carry forward to next year. So whenever needs, government normally announce, but obviously we get a more clarity on basically fiscal deficit, cost of funds as determined by fiscal deficit, and yearly policies based on import export. So my personal guess is whatever the government is doing, obviously we are in right direction. Recently, last week, EU-India trade deal will give a positive sentiment and give some clarity on capex. At same time, government should also focus on manufacturing infrastructure and already done for consumption. So job creation is the major concern for government in India, country like India, where we have a better demographic dividend, but not able to benefit it because of this. And in current geopolitical scenario, every country need to focus on their manufacturing self-reliance, because majority of the countries completely relied on US and China for their defense requirement, for their merchandise export and services. Now everyone realize, including India, so we need, as a country, we also focus on manufacturing, job creation and self-sufficiency. So we expect clarity on manufacturing, focus and support on MSME credit, and for you exporters also, whatever is possible. And that's a need, that country need this. And if you want to drive the 7% GDP growth, definitely there is a limited ambition government to spend money on capex or directly, but reforms can be done. Let's take an allowance of clarity on FDI. A lot of things can be done by government here, by improving taxation part also, or maybe new deals support from any country. So that can be done very easily without any hurt on fiscal deficit portion.
Okay, in the economic survey, the government took note of the fact that, of course, FPI flows have been fairly, volatile. Now that it has found mention in the economic survey, do you expect any kind of tinkering with taxes? Because, LTCG for foreigners, could that be tinkered with? There's a bone of contention in terms of the withholding tax as well. Do you expect any such changes, from the government?
See, it is not an expectation, it is a wish list. So if you see globally also, dollar index is falling, and that's reflecting in all commodities. But it is not reflecting in emerging market country like India. Because I think it might be because of long-term taxation, or maybe some other like fundamentals or earning growth. But it largely seems to be depend on the long-term taxation. And I think we also everyone expect we needed some clarity on this long-term investment, especially for FIs, because current account deficit is very important for a country like India. Whatever is maybe we reduce from 3% to 1.5% or 1.2%, but still this gap is completely filled by FPI and FIs. So we do expect some clarity and some sort of rationalization in taxation.
Okay, expect some kind of rationalization and clarity on the taxation front from the government in the budget. But let's talk about sectors from our viewers' standpoint, investors' standpoint. What should they do with sectors like defense and railways? Because these sectors tend to pick up traction ahead of the budget. For defense in particular, world over, we are seeing higher defense spending in light of what's happening on the geopolitical front. For us as well, post Operation Sindoor, the outlay for defense is expected to rise. The stocks have seen a fair bit of correction, but valuation-wise, would you be of the view that much of the froth has been cleared, or would you say that there's more to come? So perhaps one should wait it out before getting into defense names. What are your thoughts?
See, definitely, current geopolitical situation actually favoring the sector, and every country is increasing their defense allocation, including India. But India is in slightly better position where we have two options. We can actually indigenization can again improve the defense manufacturing, and at same time we can export also. So now today the defense companies are not only depend on the government procurement. It is also I think benefiting because of exports also. If you see some of the companies getting good orders from export as well, because not every country has a manufacturing capacity and capability also, because of manpower requirement, because of the availability of land and metal and raw material, whatever is. So we do see a good traction in export also, and at same time, government is also focusing on indigenization. So coming to your point, definitely the sector will be continue to be in high growth for next few years, but we need to check the valuations and management quality and fundamentals, how they behaved in past and what are their capabilities. But this sector will attract more capital in future, either in FDI or maybe from investor point of view, because whatever happened in last 1 year, it's shaken everyone's confidence that nobody will rely on US or any country like, and you don't know who is your enemy and who is your friend. So you need to some reliance on whatever is possible. So some of the countries like Germany, Japan, they are starting from scratch, but definitely we are hearing some traction from these economies also, because some portion will also get sourced from India. That's what we are hearing from market. So I think one is government procurement, second is indigenization, and third is export. Is the three big drivers for India defense sector and stocks.
When you talk about export, exporters have gotten a fillip, right? After the India-EU FTA, rupees also at 92, almost there. Today, of course, there's some bit of strength coming in at 91.91. Earlier, yesterday, we had hit 91.99. But what's the case for exporters now? Of course, the India-US FTA hasn't come through, and we've seen a fair bit of correction play out in some of these names since April of last year. But recent times we've had some good news as well to cushion the impact of the tariffs from US. So would there be a case to look at exporters, at least from a valuation standpoint, and the currency tailwind as well?
If you see the biggest beneficiary is a labor-oriented sector like textile and marine exports, right? So these are the two major beneficiaries, and it may not be exactly impacting positive sector, but it will have a positive rub-off effect on overall economy of India, because large, basically textile and marine, basically these two sectors employ majority of the employment after agriculture actually. So it gives a positive flip, and in terms of increasing quota, and in India you deal obviously improve the sentiments for investor as well. And more hurdles will open up, or more and more gate will open. The stories will be just saying, but at this point of time, textile, gems and jewelry and marine export looks, textile actually on an average tariff was 10%, marine roughly 15%, and maybe auto is still 3.7. Other sectors impacting maybe 2 to 3%. That is not very meaningful. But we are also expecting auto could be one of the biggest winner because majority of the forging companies or maybe casting companies which require for defense and auto, they can source from India, because there are only two countries where you can source, like China and India. And considering what is happening geopolitically, India seems to be in better position. And this will again opening a gate for other countries as well, like Canada. And I don't see any negativity, but surely it may take some 2 to 3 quarters. But we might be late in terms of Europe trade deal after this deal is signed after 20 years. But directionally, we are right.
Okay, that's interesting points raised by you. But I also want to shift focus to the consumption side then. we've had GST cuts outside of budget, a lot of measures already taken outside of budget. Last year as well, we had in the budget last year we had those massive tax reforms as well. Do you think in this budget the government doesn't have the fiscal room to dole out, emphatic measures to boost consumption? Would there be targeted measures? How would you look at the entire consumption space? Because no matter what the government has done, we haven't seen FMCG, even consumer durables, pick up, in a meaningful way. So how would you approach consumption, keeping in view what the budget might do?
See, we need to understand what is the core problem for mass consumption. After demonetization, GST, and COVID, majority of the unorganized businesses actually closed, completely closed, and that has increased the unemployment in that category. And most of the unorganized employer cannot be employed in formal sectors. So that has impacted the mass consumption. And second portion is the consumption is also impacting due to job losses and not growing the income at the bottom of the pyramid. So if you see the discretionary consumption, it is going up. And if you see, again, automobile, we see a good traction in automobile as well. So it is not like that it is not benefiting, it is benefiting, but at the same time, the core concern of particular income bracket is basically job creation. We need to focus on job creation. Then only you see meaningful consumption improvement in overall economy. But if you see if you see the income bracket, if you see the income bracket above 30 lakhs, the consumption is good, and in above 50 lakhs, even better. It means the discretionary consumption growing at very healthy pace, and at the same time, staples, mass consumption actually struggling, because we need to break segment wise. So that particular segment is suffering, and I think job creation is must in all sectors, and that's why we all are expecting some measures towards employment in manufacturing, something where the employment could improve, and some impact, some positive rub-off effect in basically agri-economy as well, because still agriculture directly indirectly employs almost 8% of population. So that's particular, because of the low prices, low inflation, that particular population is still struggling.
You mentioned autos as well. Of course, a lot of impetus would be on boosting jobs, growth, etc. But you mentioned autos as well. Autos have, after years of slowdown, we saw traction in autos, especially after the GST cuts. That was one sector that was the most benefited after that change in GST rates. But would you say that that much of the benefits have already played out? Because in recent times, you've seen autos coming under a fair bit of selling pressure. Is that just temporary profit taking, or would you say that much of those benefits have already accrued to the sector?
No, I don't think. See, it is just a beginning. Right? GST cut is forever. It is not a one-time benefit. At the same time, because someone has actually bought a car 6 months back, 7 months back, definitely there is a replacement cycle. So he's not going to buy immediately. And ownership of car, if you see the penetration in terms of SUVs or maybe premium cars, still limited. I agree. There is a issue with mass budget cars or maybe low price cars, but we need to focus on higher end cars or the SUVs part, where we see a good growth and demand is still there. So we don't see any. There will be normalization, but I don't see any suddenly a drop in demand, because aspirations are growing, income levels are growing. So, and it is a because some portion of the India population is still above the per capita GDP. It's almost equivalent to the European countries. So they can spend money, and their aspirations are high, and improving the roads quality. So overall, if you see the overall combine all things, so definitely we don't see any major impact on demand after 2-3 weeks.
All right. Okay, that's the point. Point taken. Yogesh, with that, I would like to thank you. But it was a very, very interesting chat, and I had so many other questions to ask you. But due to paucity of time, I'll save it for another day. And of course, we'll have the budget announcements on Sunday, so we'll have a lot more to discuss next time we meet as well. Thank you for taking out time and joining in. Lovely chatting with you, and great perspective. Thanks a lot. On that note, take a look at the market before I bring on board my next guest. 25,275. The low point of the day was 25,218. So we are off the opening lows, but still below that 25,300 mark. And of course, we've snapped out of a 3-day gaining streak, 0.5% down on the index as we speak. But the broader markets were really struggling. Although the mid-cap index has managed to pare its losses quite a bit, and the advanced decline ratio has also marginally improved, 2:3. That's the advanced decline ratio. At the start of the session, it was 1:4. So that way, we have seen some improvement in the market breadth as well. But on that note, time for our segment Beyond the Ticker. All right, in our segment Beyond the Ticker, we are focusing in on whether or not the budget would dole out some consumption boost this time around or not. To discuss that, let me bring on board Garima Kapoor, Deputy Head and Research and Head of Research and Economist at Elara Securities. Garima, welcome to the show on Moneycontrol. I think it's the first time I'm speaking to you, and look forward to this conversation. But to kickstart this conversation, we've already seen big ticket income tax relief in the last budget. GST cuts last year, a lot has been done to boost demand. Is there any meaningful room left for further tax relief without compromising fiscal discipline? What is your sense? Because, government has already done quite a bit, but what more can it do without disturbing the fiscal discipline?
Good morning. Thanks for having me. I think broadly, last one financial year, the government has taken all possible measures in its ambit to boost consumption. And particularly, GST rationalization was an unexpected one after the income tax rebate. But going forward, remember, the income tax collections have slowed down materially because your nominal GDP has really slowed down to a handle of 8.5% from 10.5% that we have seen at least last year. So that, along with GST rate cuts and income tax rebate, has meant that you will see a shortfall this financial year of at least more than 1.5 lakh crore on your tax collections, if not more. Now, what that does is that going forward, the scope hence to be able to give anything incremental through the means of the budgetary exemptions on taxes is very limited, number one. Number two, if you look outside the ambit of budget, we already have an upcoming announcement on pay commission awards. Remember, the government formed the pay commission, the 8th pay commission committee last year sometime, and it's supposed to come out with its report sometime in the first quarter of the next calendar year. And that itself would mean, on central government side alone, an incremental fiscal spend of anywhere between 0.6 to 0.8% of GDP, which alone would be more than what the government has done so far if you add GST and income tax rebate together. As such, I don't think, with this in the backdrop, government probably neither has room to do anything more in the budget, nor I think it is needed given the fact that you have this on the anvil.
Okay. Of course, limited room for the government to do much in the budget. But, let's talk about the consumption story as a whole. Despite these tax cuts, GST cuts, consumption, especially in the FMCG and consumer durables universe, hasn't really picked up in a big way. What is it that's missing in the demand story? Is there a deeper structural slowdown in consumption, especially in the urban side? Rural is still, one may argue that rural is still doing better. But what is it that's really missing?
I want you to look at what the consumption response has been in the face of two things. One, when you entered this phase before the government gave out the concessions on taxes and GST, you had seen a prolonged moderation on job front. Incomes and wages of the corporate sector were moderating. There were significant headcount reductions on the IT sector. And there was significant build-up of liabilities on the household side without any concurrent increase in income. Now, these measures at best help to correct some of these structural factors and cyclical factors that were driving the slowdown. Now, that apart, you did see some significant boost in demand, particularly auto, both two-wheelers as well as four-wheelers. Now, what happened was a segment of the economy like auto had really not seen any uptick of fillip post since I think 2023, particularly on the two-wheeler side. Because what was happening was the rate at which your incomes were growing were far lower than the rate at which the prices of your auto and two-wheelers were rising. As such, it became unaffordable. When the income tax rebate and GST cut along with rate cuts kicked in, automatically the unaffordability matrix turned into affordability matrix. So whatever pent up was there for last 2-3 years and was not fulfilled because of unaffordability, automatically got fulfilled. Now, when you see every other component, the similar pattern has not played out because the unaffordability matrix was not really something that was driving or pulling back consumption there. The second point to note about India's consumption, and particularly from the point of view of market, is that India's consumption basket is very different than what it used to be 5 or 10 years ago. And hence, if you look at answers, mainly in the listed stock space, you may not find it necessarily as uniformly as you found earlier. For example, despite taking a steep hike on tariff, you did see ARPUs of all telecom companies increasing last financial year. So it isn't that there isn't demand. There is demand, but it is in pockets where the consumer wants to spend, or where there is a desire to spend, or where affordability is kicking in more positively. So we have to look at it as prism, which is more relative rather than absolute.
Okay. Also want to ask you that with the center stepping back as a capex spender and states expected to do more of the heavy lifting, which consumption segments would stand to benefit most from the state-led spending? If you could take us through what you guys have, mentioned in your report.
What we mentioned on board is that the government of India's capex spending is now going to probably plateau in the range of 2.9 to 3% of GDP. So we don't significantly see a boost here on anywhere in the likes of what we saw, let's say, for 23, 24, and 25 financial year. 26 financial year was the first year when the capex allocation of the budget moderated to 10% odd growth. We see similar playing out next financial year as well. We don't see the central government's capex spending increasing anywhere more than 8 to 10%. Number one. Now, but remember, the state balance sheets extremely constrained because of all the freebie schemes that states have been launching, and especially cash transfer schemes, and run up to every state election for last 2 years. So the ability of the state to carve out a proportion to spend from the balance sheet is also constrained. So that leaves you with only one option, that the center can continue maintaining capex as a 2.9 to 3%, but carve out a larger part of the role or the money to state in the form of interest-free loans. Now, interest-free loans particularly get spent mainly on aspects relating to your metro projects or urban infrastructure or irrigation or state roads, etc., which do have forward and backward linkages. Beyond this, state spending at the current point in time is also helping to somewhat maintain at the bottom of the pyramid some support to the economy, especially to cash transfer schemes, which will get reflected in various consumption aspects. Had this cash transfer scheme not been there for the last 2 years, probably the consumption slowdown that India would have seen before the tax cuts and income tax rebate would have been even sharper. It's difficult to pinpoint one particular sector when state spends versus center spends. It's easier to do that in capex rather than consumption.
Also, in your report, you've of course emphasized on rural welfare and agriculture spending, which you just implied as well. But would it be safe to assume that rural consumption will outperform urban discretionary in FY27?
My case and my analysis says that now urban will start to do better versus rural. The 3 major points for that are this. The food price correction that you've seen this financial year is unprecedented. Whenever food price collapse happens in such proportion, it if it's urban versus rural more, number one. Number two, the hiring outlook, particularly on GCCs, is improving. The salaries and wages of corporate India in payouts are gradually troughing out. And most importantly, when you expect pay commission awards to come in, it will benefit disproportionately the urban consumer more rather than rural consumer. So these factors generally tell me that FY 27-28 going forward is more positive urban discretionary rather than a pure play rural.
All right, that's the view then, Garima. I'll have to cut it short here. It's kind of running out of time. But lovely having your inputs, and of course, that's how consumption is expected to go along, especially since you mentioned that the government doesn't really have a lot of fiscal room to dole out emphatic reforms when it comes to boosting money in the cash of in the hands of the consumer. But look forward to our next interaction as well, Garima. Lovely insights, and look forward to reading your next report as well after the budget. Thanks a lot for taking out time and joining in. It was truly a pleasure chatting with you.
Thank you for having me. Thank you.
Well, on that note, it's time to say goodbye. Just take a look at the market before we do that. We've paired some of those losses. In fact, the Nifty is back above that 25,300 mark as well. Mid cap index is almost about to break into the green, you may say so, because it's just about a 100-point cut on the Nifty mid cap index, down 0.2%. So it's now starting to outperform the benchmarks. We'll have to see whether we manage to edge back into the green and stage a good recovery, because that's exactly what happened yesterday. The advance decline ratio is almost even Stevens, although still skewed in favor of laggards, but it's still much better than how we started the day. 1:1 almost, with declines outpacing the advances. But let's see whether things change here on or not. The list of gainers has kind of become a lot bigger now. Nestle, Apollo Hospital, ITC, Tata Consumer. So some consumption names are doing well. HUL, even that is trading in the green, up 0.5% or so. So some traction in FMCG names. Trent as well is up 0.3%. Bharat Electronics is also trading in the green. But what's not doing well, is metals and IT. Hindalco, Tata Steel, Infosys, HCL Tech Wipro, these are some of the top laggards on the Nifty, but things have seen an improvement. Let's see whether or not we manage to break out in the green on the mid cap index soon, and of course even the texture of the market, if that could reverse in the second half of the day. But with that, completely timed out on this edition of Opening Bell. Thanks a lot for tuning in from the entire team. Of course, we'll be back with a lot more on Closing Bell at 3 p.m. Stay tuned to Moneycontrol for all your budget related stories. You could read everything. Just log on to moneycontrol.com and you'll have comprehensive articles on what to expect from the budget, on consumption side, on the big numbers to watch, on generally what the expectations are really like as we head into the big day. Thank you for watching. Stay tuned to Moneycontrol, and I'll see you soon.